financial services pricing. How many of us are involved in pricing in our various companies? You know, like broker, for example. You know, I know that you'll be involved in one way or the other.
Yeah.
Is it Kofi or Kwame?
Kofi,
sir.
Well, basically, the basic prices are determined by the insurance company.
That's right.
And depending on who you are serving and the kind of service you are giving to the person, the pricing will differ from within a certain range.
Yeah.
And also depending on which company you are dealing with.
Yeah.
Because the regulator sets a certain price rate for
That's the key point.
Yeah. And then we then take it from there.
That's right. That's right. So there are many contexts when it comes to financial services pricing. Like key is the regulator. So you are not at liberty to set prices like your hotel or like airline industry or like maybe what do you call it? What other industries? Maybe breweries and estates. You know, yeah, you don't have the liberty to set premium pricing. You understand? Because the regulator has regulation towards it. To what extent you can price. This is the base and then the top. So you can't go beyond that. You don't have the luxury. So you have so many factors that actually determine the pricing for financial services, and that makes it very difficult. You know. So we're going to look at some of these conditions, and we'll look at some of the ways, the many ways that you can price in terms of looking at the competition, in terms of looking at the demand, and in terms of looking at your own cost structure. That's what we're going to look at today. So we'll do some practical stuff so that you can have the feel of it, and then you can make inputs when you go to your various companies and when you're involved in pricing decisions. So we're saying that there's a tripod of cost that we have to look at, and just like Kofi was saying, I mean, first tripod is about cost incurred by the customer and service providers. The cost of money, for example. All right. If you are pricing, you're not only pricing looking at your own cost, but the cost to the customer. All right. I mean, when we say cost to the customer, we're not only looking at even the economic cost, I mean, paying money or whatever, but the fact that the customer will go a particular length to acquire the product, the psychological cost as well. Forgoing an option and to go for a particular option. You understand? You know, why would someone want to go for maybe an investment product instead of banking services? All right. Do you put your money there for savings, or do you use it to buy shares? All right. And these things involve a lot of emotions, you know, because investment you can lose. Banking you may not get so much out of it. So you are actually having a trade-off, and your mind is not at ease. Constantly scanning through, constantly, and it takes you it can take you your whole week, because it is not a product that you can easily understand, you know. So you'll be asking colleagues, you'll be checking online, you'll be doing this, you'll be doing this. It involves a whole lot. All right, so you are looking at the cost to access the product from consumer perspective, but also you're looking at the cost, you know, from your own angle. When we say cost of money, what do we mean? In banking, for example.
You know, the interest on it.
That's right. Because you see, in banking you aggregate deposit, don't you? And then you give that for loan. What are the ways that you get money to give loans? By buying from the wholesale, maybe from interbank. Yeah. And then those things you have to pay interest on. You have to pay so much. So if you're not able to aggregate enough deposit in order to give it as lending, all right, you've got to go to the wholesale, the banking, the market, to borrow or to get that money to give it for lending. And it involves a lot of cost, you know. And the cost is not, like I said, only interest, but you have changes in the economy. Sometimes, like what happened to us. 1 week, boom, inflation. Central bank then comes to say that base rate, and slash it. You understand? So there's so much uncertainties when you're actually setting up your pricing. So it's not a smooth sailing, especially when it comes to financial services. In other businesses, yes, people have the liberty to, because, for example, Holiday Inn can set premiums, price premiums, because of the brand. You know. So they have the liberty to set premiums that when there are shocks, they can still be protected. But in banking and financial service, we haven't been so successful in creating brands that can demand that premium. And if you can, the regulator won't allow you. You get a point? So that's some of the difficulties we have in setting prices. And we're saying that competition as well. The absence of effective branding has led to price as determinant in trade making. And that's true. You know, and the pricing as a trust making is not only like how much is EcoBank loan rate, you know, to, I mean, when you take a loan from EcoBank to Fidelity. But again, you're looking at repayment structure. And you're looking at, what do you call, whether they can stagger it within a period of 48 months or a period of 24 months, or, you know, they all have this kind of patterns. So the payment modalities can differ from one bank to the other bank. But maybe you may have the same base rate, or you may be working with the same base rate. But where you differ is about whether you can allow the person the latitude over, what, 24 months, and the other can allow the latitude over 48 months. That's where the competition revolves around. And at a point it becomes, let's say, a price war. All right. What if the customer is so much exposed to risk, you lose your money if you allow that latitude? 48 months, by the 28th month, he's lost. He's nowhere to be found. You lose money. So there are so many uncertainties when it comes to pricing that you have to factor in. Then the next leg of the tripod is the customer demand. The wealthier the population, the greater the demand for financial services. Is that true? Like what?
Yeah, with the competition in the price. For instance, with Fidelity, if we are loaning to a company or the staff of the company, and they have a provident fund, they are on provident fund, we have the luxury of giving them 48 months to pay. But companies that are not on provident fund are exposed to a lot of risk, and so those are the ones that we give 24 months.
Yeah, that's right. Yes. So these are some of the factors you take into consideration. So you couldn't say that, yeah, because of competition, let's give 48 months. No. There are certain factors. To what extent is the customer or client exposed to risks? And how do you offset that? These are some of the factors you have to consider. When it comes to insurance, again, yes, you're looking at health grounds, you're looking at the person's lifestyle. Is he a fast car driver? Pushes up to the motor, boom, is gone. So you look at all those factors as consideration. And then we're saying that when the population is wealthy, they demand a lot of financial services, loans, insurance products, pensions, because they can afford to. You understand? When the population is not wealthier, they don't even go to the bank, let alone to ask, So again, it's another consideration. Which market are you serving? What's the characteristics of the market? The wealthier market or is the downstream market? The downstream market, what's the capacity to repay loans? Or what's their taste or their demand for financial products? You've got to assess all those things in terms of your past. What do you think is the monthly fees for your check account? The check account. What is the monthly fee? You can't just say it's this. You have to consider many factors. Sorry for using dollars. That's cost of $500,000 term life insurance. So you replace that to C's. Insurance policy. The fees for 2-hour financial advising session. How do you price that? You see the difficulty. And then the prime interest rate percentage, interest rate for your savings account again. So we're saying that, you're not supposed to answer this, but these are some of the things that to spare your thinking about how complex the whole pricing is. Okay, so let's get into some complexities of financial, services pricing. Auto lease, 269 Ghana cedis a month, 35 months, and you have 2,499 Ghana cedi down payment. So you're saying that 14,395, 36th month balloon payment and wear and tear penalties. Okay. So let's see. If you have 269 per month for 35 months, obviously you've got to understand some of these things that we have discussed and see how much down payment the person has to pay, and then you spread the rest over the month. Taking into consideration the environment, like we talked about, the exchange rates, the inflation figures, and all the competition, the demand, the lifestyle of the consumer things. Home insurance, again, you have the premium, the dwelling coverage, personal property coverage, payment cycles, living expenses, liability coverage, guest medical expenses, discount allowed, mortgage, interest rate, points charged at closing lock-in period. You know lock-in period?
No.
Lock-in period, usually, you see, it's either you want your payment to be locked in so that it's not affected by changes, fluctuations in interest rate.
Okay.
Yeah. Or you want it to be exposed. Like what we have what a variable or variable interest rate or fixed interest rate. Now,
in Ghana, usually the dollar mortgages have a fixed interest.
Exactly. So that's what we call a lock-in. So you pay for that, and it has to be considered. So the company or the financial institution has to consider rate of changes, predict whether for the next 5 years there's not going to be enough fluctuation or whatever fluctuation is. And they use it to charge you for locking in your mortgage payment for a particular fixed amount. Are you with me? All right. And then check account, basic monthly fee, number of checks allowed, additional cost for checks processed, minimum balance. All these things affect how much you're paying for your check account. So you've got to take into consideration some of these things.
But you can tell the customer.
Yeah, if you're transparent, you have to make your cost items known.
You tell.
But most banks don't. Most banks don't. Why don't you? But you see, we don't because the regulator doesn't demand of you. When you're in a regime where the regulator demands that, and customers are aware that you've got to you've got to actually disclose some of these cost items, you would. Because if you don't, the financial regulator will come hard on you for deceit and for improper practices. But in our case, I think it's a little bit lax. So banks and financial institutions actually get away with it. Challenges in pricing financial services. Again, financial services are multifaceted, of course. Example, life insurance, you have coverage amount, exclusions, length of policy, premium. So all these things are considered. Quantifying costs may be very difficult. Because let's say, for example, your fixed cost is fixed, regardless of what operations you are performing. So the deposit or the savings department or whatever department is doing this, the loan department is doing this. At the end of the day, how do you allocate the fixed cost and cost? Are you allocating them based on what they are bringing in? Or are you allocating them even? You see? So it becomes difficult to think of how you're going to allocate the cost or you're going to what cost structure you're going to have. But of course, companies have their own way of doing it. So it affects pricing. So if somebody comes for loan, how much or what's the percentage of fixed cost is he paying on the loan? And what's the percentage of fixed cost someone who is doing savings? There's a savings that you charge on it, or current account. So you see the difficulty. So at a point, one customer is actually worse off than the other. Because perhaps the one who is actually doing the loan may be paying more. And you slapped a lot more of fixed cost on him than the other. Depending on the setup of the department. Because maybe that department doing the savings or the current account may be maybe 2 or 3 people staff. The other one may be having maybe 5 or 6 staff and things like that. How do you spread the cost? over these products. Is that clear? So these are some of the difficulties in pricing, but then we'll come to the real quantifying, the calculations that it's very to see. We're saying that quantifying profits associated with a given client difficult due to bundle relationships. Again, we have products that are bundled, isn't it? When it comes to financial services, most products are somehow bundled. What are some of the bundled products?
For instance, what's COT? When you check COT account,
Yeah.
customers can at times negotiate with their relationship managers, and there are times work things out for them to beat down the price a bit.
Yeah.
Because some customers, they really run their accounts, more deposit, more withdrawals and all that. So when they talk to their relationship managers, what they do is they try and cut down the costs for them.
And sometimes you bundle products because, for example, if you have a funeral something?
What's insurance?
Funeral policy, insurance company, and then it's not lucrative. You try to bundle with another product. Just to make sure that people, and I think these people, Airtel does. You buy credit and then it contributes into certain insurance policy. And financial services, most financial services have similar stuff. Where I remember when I used to be with Barclays, we used to have something called open plan. So whenever you deposit money into your account at some point, it switches into your open plan. You wouldn't know that you have an open plan and you get charged. So these are some of the things that little tricks that the financial institutions have that sometimes the customer even doesn't know. And it presents an issue. So sometimes you don't know which of the service or product is making profit because you bundle it. So it may take you a while to identify where the profit is coming from. Is it coming from A or B product because they're bundled? And then price and value are a function of economic conditions, for example, interest rates. Quality is elusive and may be intangible. True, consumer price memory is very weak. We discussed that last week. And then you have potential channel conflict in pricing. For example, brokers versus the originators. So in your industry, for example, where the actual insurance company and you, the brokers, may differ or may have some difficulties in terms of channel conflict, in terms of pricing. And regulatory constraint, again, on pricing may exist. Okay. Role of price in financial services. Again, we know that the role is what? The price role is what? The sole source of revenue. And usually you call them what? Fees and things like that. And that's the sole source. Commission, sometimes you call it. So you set prices to what? To get revenue. And again, to signal to competition. Obviously. Maybe, like you said, you may have 24 or 48 months repayment, and the competition will say, wow, we have to match that. Or we'll call the customer and say, oh, how long are they asking you to what? To repay your loan? Oh, 48 months. Oh, we'll match that. And we'll add extra whatever to you get it. So it's a way of getting revenue, but also it's a way of competing. And then a signal of quality and value to the customer. So the longer periods, let's say the longer months you give the customer, you're giving the customer value because you're giving the customer breathing space. Space where they can use the other funds to do it, to work. But if you have to reduce the months, then the customer is stretched to bring in money from other sources, which otherwise they could have used to operate. So again, it's about offering value to the customer. You set the price in a way that you can offer value to the customer, or you can signal quality of service. Yeah.
So I definitely get the value, a signal of value to the customer. At quality, how do you show a signal of quality? For instance, if a bank is charged is giving you 48 months for repayments of your loan. How does that signify, or how is that a signal of quality?
Service quality is actually, defined in many ways. However, quality not in terms of the technicalities of the product or the service itself, but relations, human relations, or relationship marketing. You understand? Now, does the customer see quality in terms of convenience? Peace of mind. You know, it's a dimension of quality. I mean, if a bank can give you that peace of mind in paying without necessarily stressing on your family, it's a quality dimension. Do you agree? Yeah. So in financial services, you define quality not in terms of just the product itself, the technical quality of the product, but then again, to what extent does it allow you convenience, freedom? You know, it's part of the quality dimension. So you're looking at that as well. Like mortgage, you're not going to be disturbed at the challenge. We're going to board up. We're going to board up your house. It's not going to give you quality of life. You're always stressing, going to family people, asking them for money to come and pay off. I remember in the UK, people stress on that towards the end of the month. That's why people hardly change jobs. Because when they're changing, they want to make sure that they have money to offset or to pay off their mortgage. So people work 24/7, and they only take holidays, planned holidays. Because as soon as your wage don't come, or your wages don't come, you're dead. The mortgage, maybe they may allow you 1 month deferment or 1 month, The following month, if you don't go there, they are coming to board of your house. So that's how come we define quality in that dimension. Any other? Again, pricing objectives for financial services. We price with the objective that we want to increase our market share. Do you agree? So where increased market share means price is lower than the competition. When you set your price lower than the competition, you want to increase the market share. And we've seen a lot. Fidelity did something. Your promotional things may not necessarily be prices, but it's geared towards that. When you want to, because you're giving out money, technically speaking, you're actually beating down your cost of business, isn't it? Yeah. So you're aiming towards increasing market share. So you set the price low, than the competition. And then profit generation, you set the price higher than cost. So you have a cost base with a markup of, let's say, 60% or whatever percentage you want to set. And then profit maximization. So you have the price based on perceived customer value and the demand function. So again, what does the customer perceive as value? So if you say that maybe you give the customer option that coming into the branch, accessibility vis-a-vis convenience, for example, which one do they value as the most important? And the customer thinks that accessibility. So you try to site your branches almost near where the customer lives, your target customer is. And then you little bit raise, fees in order to cater for that accessibility. Or you set up ATMs or any other mode of accessing the services, and then you inch up a little bit to cater for that. So you can argue that, because accessibility is very important to you, and accessibility means convenience, are you prepared to pay X amount just to make sure that you can access your financial services at your doorstep? So it's another way, of dealing with the price. Then pricing methods for financial services. So we're coming into how to calculate some of these things. Obviously, we have regulation-based pricing, which means you're setting a price based on what the regulator is actually, saying that you should or is coming out with. You have cost-based pricing, where, of course, you look at your cost background, you set the price. Parity pricing, value-based pricing. All these ones, are not mutually exclusive, because before you even set your cost-based pricing, you still look at the regulators. Yeah. And then if it's about parity pricing, you can't just say you want to set your price against what competition is offering without looking at what the regulator is saying. So by setting your price against what competition is pricing, invariably means you're taking into consideration what the regulator based price, because the competition is also looking at the regulator. All right. So they are not independent. They work together. Any questions so far? Or contribution? Alright, so we're saying that regulation-based pricing means the regulator, forget about this federal, state, and everything else, but we have only one regulator, central bank. So the central bank set prices to be charged, or ceiling levels. So you have either the central bank or the insurance people, the National Insurance Commission, or you have the other Apex Bank is for rural banks, rural bank and community banks for Apex. And then you have the stock exchange one, is what? Ghana, what's the name of the stock exchange? It's SCA, Ghana Stock and Securities Commission. Securities Regulation Commission, yeah. So all these regulators would have some base fees, but of course they're all controlled by the central bank. I'm sure they all work within those parameters of the central bank. So financial service provider primarily functions as a distributor, not necessarily as a price setter. So, and especially when it comes to insurance, whereby certain things, insurance are what? Compulsory. I mean, auto insurance, is it compulsory?
Yes.
Yeah.
Yes.
So basically, you are just distributed, because the state is in control, and then the financial institution was distributed. Then, some like flood insurance here we don't have. Do you have flood insurance?
It's covered under fire insurance.
Yeah, but is it compulsory?
It's now compulsory
For companies.
commercial.
Okay. Okay, good. Yeah, so there's some sanity. Hopefully we'll come to individual consumer market. Yeah. So you have that, and you have reverse mortgage fees and others. Yeah, reverse mortgage fees. Can you explain to us? Oh, you know. Yeah. Now, you see, when you have what you call mortgage, obviously you're supposed to make payment towards it. But at the point when the consumer is not able to, you have certain, regulator allowances that actually supports the family. So trying to figure out, like if you have your mortgage with a bank, you can have it as an insured, and it's mostly compulsory. So that just in case you are not in the position to do that, then of course the insurance actually takes it out for you. So it becomes a fee paid on behalf of you in times of difficulties. So that one is a regulatory, measure to sort of protect, families at a point of difficulties. Yeah. Any other?
How different is that from the mortgage protection?
The mortgage protection, yeah. So that could be the same. I think that could be the same meaning to it, because you see, one thing is that the mortgage protection, is it compulsory or optional?
It's compulsory when you are taking a facility from a bank.
Okay.
When you are taking a mortgage loan.
Yeah.
And so that one protects whoever is taking a loan as against the bank. And the insurance company is going to act like as a collateral for a guarantor, so that in the event where the person that passes on.
Yeah. So it's sort of the bank is actually protecting itself.
Yeah.
Yeah. I think that to some extent it could be the same, only that this one is regulated. Okay. And then cost-based pricing. You have cost of transaction services used as lower bound for prices. So for example, you have your markups applied to reflect the business objectives. So if the business objective is for you to what? Have a market share or to increase your market share against competition, then of course you know how you're going to set the markup. So that it's not greater than the competition for you to get more. If it's about profitability, then it means you set up the markup in a way that what? You get more profit, not necessarily market share. So you have the price here equals to the cost times the markup. That's the common pricing strategy, isn't it? So how much does it cost you to produce that particular service? in terms of salaries, in terms of lighting, in terms of space, all these things put together, multiplied by how much you want to put up as your profit. So if it's about 20-60%, you put that on the cost. So how do you estimate cost? So we have here, for example, and let's do this calculation and see. You have 100 active accounts, all right? And the average monthly transaction cost per account is one cedi. So you have your overhead and fixed cost of branch. It's 400,000 Ghana cedis per month. Now, your total cost here is this 1 Ghana multiplied by what? The 100 customers active account that you have. So that gives you 100,000, isn't it?
Yeah.
So you plus it to your overhead fixed cost, which is 400, and then you get 500,000 per month. Now, if you are estimating how much a client or a customer costs you to maintain, then you have to divide that 100, which is the 100 active customers, by what? Your 500. Isn't that correct? So that gives you what? 5 Ghana cedis per month, which means per every customer, you're spending 5 Ghana cedis on it. So that is your cost. How do you determine your profit? So then you come to your markup. How much markup do you think will be good for you? And then again, you are considering a whole factor. A lot of factors. Like we said, you're considering competition, you're considering interest rate, and all those factors. So you set up, let's say, 60% markup as your profit. So you work out 60% on that, and that gives you this. So you have monthly fee of what? 5 Ghana cedis. Multiplied by 1 plus 0.6. 0.6 is this, the 60%. And that gives you 8. Which means if you sell the item 8 Ghana cedis, you're okay to achieve your 3 Ghana as your profit. Because you have your monthly, 5 Ghana as your monthly cost. So that's how you arrive at your cost base. But like we said, this cost base shouldn't be explicit. It should take into consideration the regulatory issues and things like that. Because does the regulator allow you to sell it at 8 Ghana? So these are some of the things you have to consider. Are you with me? Any questions? Alright, so let's plug in different figures and see what we can get. Let's try it. Let's assume that here, let's change this place to, let's say, 300 customers, 300,000 customers. Can someone work it out for us? So we are saying that we have 300,000 active accounts. All other figures stay the same. So let's work it. Yeah, active account. Which means the average monthly transaction cost per account still remain 1. We still have our 400 as our overhead. So where we change is here. So how much are we going to get as our average cost? 7 cedis. Yeah. So we have 7 cedis, then our markup still remains at 60. What do we get? So if we sell it at 11.2, is that a case?
No, it means that you're going to sell.
Sell it at what? So 11.2 plus the 7.
That's the monthly fee.
Yeah. that thing, it brought some. In fact, we were discussing in the office, and people were bringing board marks, and and I was doing it from cost accounting perspective. From cost accounting perspective, you only multiply the cost, the average cost by the markup, or you multiply markup of the average cost, and then you get your your figure. And the mathematicians were actually doing math. So it depends on how you can do it anyhow to arrive at the figure. Yeah, that's what the board mass people were doing. Yes. But I was doing cost accounting. Yeah, whichever way you do it should. Yeah, you want to say it open.
At the average cost per account, that's it that the account holders are 300,000.
Yeah, 300,000.
So coming to the total cost, you multiply $1 by 300,000, that gives you 300,000.
That's right.
You add it to the 400,000.
Yeah, that gives you
700,000. So the average cost per account will be now 700,000 divided by 300,000.
Yeah.
That gives you 2.33.
Yeah.
Okay.
Per month.
Per month.
Yeah.
And
So mark up on that.
Mark up on the 2.33.
Yeah. That's what I do. But you see, the mathematicians were doing it this way, where you have the monthly fee, which is 2.33, multiplied by 1 times 0.6. Is that the way you guys will do it? Yeah. Is that right? That's wrong.
So the 60%, 60% of
2.33. So 0.60 times 2. What? What did you get? 2.33. I get 1.39.
Approximately 1.4.
Yeah. Yeah.
You add the 1 to 0.6.
Yeah.
And then you get 1.6. So you multiply it by the 2.
Okay, so add the 1 to. Okay, let's do it that way and see what we say. 3.7. Okay, so 3.7 plus. Would it be plus or would it just be 3.7 as where the 8 is?
3.7
Yeah.
minus
Just between
2
Yeah, here.
Yeah.
Okay. Okay, so that would be your selling price. Right? 1.03.
That's a profit.
That's the profit. Yeah. So that's your profit. So basically that's how you're looking at the cost-based pricing. Any questions? Anyway, we'll get other examples to do so. These are some of the services and cost range that we have. Some of the things in financial: debit from check, cash in check, deposit into check account. This is purely US-based kind of cost, like the banking services, some of them. I don't know whether our charges range is like this. Like debit from check, do you charge?
No.
Cash in check, do you charge?
No.
Are you sure you guys don't charge?
No.
You charge, you see?
We charge when it's less than 400 dollars. Yeah.
You see, so that's the pricing competition.
Yeah. We charge on the basis that our ATMs can take care of that. So
so if you do that ATM, you don't get charged.
you don't get charged. But you're talking about debit from check.
Yeah, that's from check.
So it deters people withdrawing lower amounts from joining the
So it's a deterrent. You want to push people to it.
But an ATM charges you.
No, we don't.
It doesn't be this.
So if you write in a check of 100 you bring someone to 100
From your account, yeah, you be charged.
you be charged.
Yes.
How much? It's one account.
3 CDs.
What's that part?
Oh, yeah, no. Yeah, it should be one. It's still with deterring people from joining the queue. I mean,
I can't give to the person my ATM card to do it.
or you need to pay the person.
Yeah.
And so you draw for the person. But issuing a check of 400,000 from 400 Ghana cities. You charge over the counter. Unless the person is paying interest on account.
Yeah.
But it has to be.
Okay. So limitations of cost-based pricing in financial services. Obviously, allocation of fixed costs across multiple services is difficult, like we said, and sometimes impossible to quantify. So, like we discussed that, how do you determine which of the departments, get a particular cost base? Because obviously, you're all working in the same building. So you have the loan, whatever, you have the cost, the savings team, you have this. So who gets what particular, allocation? Technically speaking, you're supposed to allocate cost based on what your services are and what you're bringing in. But it makes it difficult for you to allocate fixed cost. I don't know whether you guys have a way of doing it in particular branches. Do you have any idea how you guys allocate fixed cost?
Yeah, what happens is that every branch has its own fixed costs. And then allocated cost as well. That is the cost from the head office. Head office staff. Whatever they do. Is shared among all the branches.
We pay for it.
But when it comes to the branch itself, do you allocate cost to various sections in branch? How many? What's the typical branch? What do you have? What divisions do you have in a typical branch?
Operations, back office. The back office. Operations and then sales and marketing.
Yeah. And do you allocate cost to these? In terms of fixed cost to these departments?
It's branch-wise.
It's branch-wise.
Yes.
You see, so that's how come it's difficult. Because then if you have to say do branch-based allocations, then what goes into marketing, what goes into,
Yeah, with them it's branch-wise. And with us, every account is allocated to an RM. And so it is the RM who generates the revenue and the income. And so the cost is also allocated to the RM. So with that, the cost of the account.
No, we're talking about the costs.
Yes, the cost.
Shared by the branch.
Yes.
Okay, it's located to
the RM.
What basis?
Yes, they generate the income.
Yeah, but this is cost. Why am I saying revenue?
Yes, so they take on every cost of the branch.
So which means that, like the example that we have, if we have to say that branch has, let's say, 100,000 active accounts, it's difficult then to say that per customer, this is how much fixed cost you allocate. You understand the point? So it makes it difficult in practice. That's why fixed cost is limited as a consideration. Then you don't know how much do you allocate to a particular account per their share, in the fixed cost in order to determine how much you are getting from them or you get it. So fixed cost, if you have to go by cost-based, pricing, it's a little bit, it could be unfair, or it's a little bit difficult. But yes, it's one of the many ways of costing, your product or services. Fixed cost demand or fixed demand for service assumed to exist at all price levels. So the assumption is that regardless of whatever price level, the demand will be the same. You get it? Because per the calculation that we did, we're assuming that you still have 100,000 people demanding your product to arrive at this figure. But knowing that when you sell at this figure, you can fluctuate. Because prices could be, the market could be price sensitive. Are you understanding me? Because in this scenario, we're assuming that even if you sell this at 8 Ghana, all right, with the 60% markup, you still have 100,000 active customers. What if you sell it at 8 and you don't get customers, 100,000 customers? Are you understanding me? So that's one of the limitations of fixed cost. Because you are determining this before the customers come in, isn't it? So you're making your projection that at 8 Ghana, you're likely to have what? 100,000 customers. What if you set at 8 Ghana and only 20,000? Only 20,000 turn up.
But then you still you've covered your cost and you're making some profits.
Remember, it's actually working on scale.
But see, we did a calculation that we have 100,000 clients.
Yeah.
But our cost, the cost per the account is 1 CD per every account.
Yeah.
So whether you have 2 accounts or 3 accounts, you should make sure you're not selling below 5 CD.
Yeah. But the assumption is that if, say that you put that price out there and you don't have that response, not forget about 20,000 or whatever, but you don't have that response, you'll be forced to what? Maybe reduce it. Or you would have to go by the same price and not to have customers.
But if you're reducing it, you're reducing it not
below the cost,
your average cost.
Because otherwise it would be in big cost. But are there times where companies has gone down under? I mean, down that particular price?
If
below the cost.
If you enter into a new market, you would probably want to break even at the beginning. And let's say maybe instead of a 3 CD profit, you can decide to go with 50 pesos or 1 CD at the beginning. Or maybe not at all to go into competition. Then after that, if you are able to get your 100,000 clients and you're able to serve them, you could then move back.
Yeah. And that's why fixed cost-based pricing is limited. Because there could be other factors that you have to consider.
Yeah, so because of that, when you set up the brand, you are targeted to make a loss per while.
Yeah.
And gradually, when you open accounts and you get business, the budget is inched up a little. Then break even, like they are saying. Then your budgets, some profits for you, and a target for you to hit.
Okay. So costs can be volatile, obviously. And an example, in property and casualty insurance, prices increase when interest rates fall due to lower interest revenue from investment. Because most of the insurance companies, they use those for investments. And when there is a fall in interest rates, they are not actually realizing much. They have to then inch on the cost. They have to then pass on the cost to the client. So again, costs can be volatile in that situation in terms of interest rate fluctuations and things like that. So that's another limitation. So we're saying that at some point, you see that fixed cost could be flat, regardless, But over some number of customers, it can inch up. For example, when the branch is growing and therefore you have to open another, then it can inch up. But average cost comes down once you have the numbers increasing, obviously, like we did with the numbers scenario. Customer-based expansion results in lowering of average cost, higher profit. So that's why, that explains why most of the banks are acquisition-driven. Their target, increase the numbers, and they don't really look at the retention. They're always looking at bringing in the numbers.
Sir,
Yes.
you, the previous
slide, yeah. Yeah.
No. The one before this, And the point of insurance companies.
Yeah.
Passing on.
We're saying that when it comes to property and casualty insurance, and those of you in insurance can maybe explain a little bit. So she wants to understand.
No, I get it.
Yeah.
The point that you said, if the interest rates go down,
Yeah.
you pass on the cost to the clients. I don't know how that works.
It doesn't happen in our environment.
Yeah. But, okay, sorry. So in most cases, when it comes to P&C's insurance, because you see, you are actually insured against a particular asset, by which the insurance company is supposed to return you to that in case of any damages or whatever.
Especially in America.
Yeah, because they use your money to invest to get that pot of money for that, to kind of secure you in case you need it or in case there's a need for it. Whenever there is a drop in interest rate, you have to pay more towards servicing that particular product. but perhaps not in your industry. Yeah. That's how I work with property and casualty. So whenever there's a drop in interest, you make up for that drop. Because essentially what they do is they use your premiums that you're paying to invest in order to get the returns to secure your, so that's how I work. But anyway, so here you have to bet the brand. Okay, thanks. Alright, so example again. And I think here there was an error. Let's look at this one. What are we going to get? So we have, remember the thing that we did, the 300 that we changed. So now we have, with 100 clients, profit was what? 300,000. Remember, because it was 3 that we got as a profit, and then you multiply by. So with 200 clients, profits gets to what? 800. This one, the calculation was wrong in the book. Because how come that you have this? When you have the cost base of what, 1 city, you remember? Yeah. And then you have 200. So you're going to be 1 city times 200, which is 200,000. And then you have your overhead cost of 400, making 600. So if it's 600, then it's going to be 600 divided by what? 200. And then you multiply it. But I think they had it wrong in the book as the calculation. Because it can't be 200. I mean, we did the calculation. It was 360?
Yes.
It was 360. Maybe you can try that. Let's see. What do you get? So we can roll back if you want me to roll back. Yes. But I think, okay, so write down this figure, 200, and then we roll back and do it. So we have increased to 200,000 clients, active clients. So let me roll back to the other slide. So that's it. So here replaced by 200, active clients. And then the other figures stay the same. Yeah, so we're right. But the book had 800. That was anyway, so yeah, so we have an increase to 200 again. 360. Okay, so can you explain? Let's go. So we have active is 200. And then these figures here and here stay the same. So obviously this one is going to change. Yeah. So what do you get for average cost per 3? Yeah. So you have a markup of 60. So you have here 3 multiplied by 1.6. What you get?
4.2.
But I think I remember the instance where you mentioned that we're just multiplying by 0.6.
Yeah.
But eventually, the profit is 0.6.
Exactly.
So you're just doing 0.6.
That's what I did.
Yeah.
So 1.6 times
the 3
times 3.
Yeah. And that gives you the selling price.
Okay, subtract.
So if you minus your average cost from the selling price, and then you multiply by 200. You get it? Yeah. Okay. So let's go here. Parity pricing. Who can tell what parity pricing is? Parity pricing. Where you're looking at competition, what the competition is offering. So in parity pricing, you're looking at your nearest rival. So we're going to look at that. When you're doing parity pricing, you're looking at your nearest rival and how to match them. You know. So you have your price equals factor, that is multiplied by key competitor's price. So who is your key competitor and how much do they charge? You've got to identify it. So we have this. Competitor A is the leading market share and the leading firm in the market with 47% share, and they are selling at 938 Ghana cedis. Competitor B is the next, 21% share in the market. They are selling at 852. We are the competitor C. We are the third in the market with 7% share, and we are selling at 861. D 5%, C or E 3%. Okay, so we're doing parity. All right. So let's see. So we identify our revised pricing using A as key competitor. So we're saying that in the next review, right? In the next review, so we are going to review our pricing. We're saying that in the next review, we want to pick up competitor A as our competitor type in pricing. So what do? You have your current price, or the last year price, which is 861. Remember, we are reviewing the price for next year. We divide it by the competitor we picked up, which is 938, times their revised price for this year, which is 887. So that will give us 814. So we're saying that if you pick competitor A, reviewing their last year and then this year pricing, we are sure that if we set our price 814 for perhaps we can get some of their customers. That's the assumption. Are you with me? So whenever you're actually doing parity pricing, you're picking up a competitor, look at their price for existing your last year and their reviewed price and match up yours against it. And then you arrive at a figure. So let's do an exercise using any of these as our competitor. What are we going to get? Pick one of them and then do an exercise. Let's see. That's the principle. The rule is, yeah? You want to say something? Yeah.
I think because after 20 hours,
this is a basic word.
Basic?
Yeah.
Hey!
Yeah, the principle, understand the principle here.
How come the competitor has 1,090, meanwhile this percentage is 3% compared to?
Now this one is how much they are selling. So perhaps that's why they are at the bottom of the competition, because their price is too much. So people are not going there. This is their market share in the market.
ASC competitor.
The AS.
Yeah, just pick any of the competitors. See, this is in the market, right? This is their positions in the market. It has nothing to do with how much they are selling. But that's the market. Let's say this is the leading competitor, this is the bottom competitor. But you can understand why they are bottom competitors. Because they are not getting market share because their prices are high. They are skimming. If it's a skimming price, normally companies that go on skimming or premium pricing, they don't have big market share. Because they operate on premium. You understand the assumption?
But what if Turkey has 3% market share?
Yeah.
And the price is 1,000.
Yeah.
And they are making, for all you know, they're making more profit than A.
Yeah, okay, but market share is different from profit. Market share is about the size of the market. Yeah. Because you can have Stand Chart and go, making larger profits in terms of value or having good books, but not necessarily in terms of numbers.
We do the legal.
Because they do the premium stuff. They do the big tickets. So you may have EcoBank having the entire Ghana, but not making as profit as you get it. That's the assumption. But yeah, so pick up any of these and let's compute parity prices. You chose B. B. What did you get?
803.
803. So if you choose to parity price B in the coming year in your review, you get 803. Alright. Who else? You have done something. Using
D.
D. What did you get?
691.
691. Okay. So, and then let's add all those prices together and see which one will be favorable. What else? Can you do one for me, please? Do this. So this one is not continued. This is the basic pricing models. can advise your bosses on parity pricing and make input in it. If you are targeting EcoBank as Fidelity, target EcoBank as your next competitor in the next year, this is what the kind of thing you do. You look at the previous and you look at the current review pricing, and then you match it. It's a very good model for continuing.
D&E wouldn't require revision of the price.
It wouldn't require revision, yeah. Alright. Who else has got other figures?
So for
A and E.
A and E. Yeah.
The right prices.
963.
963, right?
963.
Which one?
For
So
C
it's
and A.
E and A. No, but we are C.
We are C. We are competitor C.
We've done that already.
And then, okay, but you are also alternating. Okay, they are trying to answer. Okay, they are trying to answer.
Okay, then it means we will change their revised prices.
Yeah, obviously.
Yeah.
Alright, let's see something. So our revised price using B as key competitor is 804. Yeah, we got that.
So it's, for example, E and D.
Yes.
It's E
Yeah. So that's the principle is this.
1019 divided by 98 times 887.
Yeah, so
That's how but you see, you don't do this in isolation. You have tested the market to see whether setting the price at that would get you the customer swaying to you. You understand? So if you parity price in that sense, obviously with other factors determined, would it sway the customer to you? One of the question is this. So you can have scenarios. Scenario one where you pitch competitor A as your key competitor to parity price, competitor B as, and then you can match the scenarios with the market. How is the market going to respond? Usually you do this by sending surveys. Alright. At a price of, you have done that at the bank office. You don't tell the customer. But you send the leaflet to the customer that at the price of this. You look at the customer's response at the price of this, at the price of this. When the customer responds that at the price of that, I would respond, then you know who is going to be the competitor. You get it? And sometimes you can target the customers, the competitors' customers. Alright. So say that firm A, customers, and you've done the calculations and you've seen that when you parity price, this is how much it's going to be. You can send the leaflets to firm A's customers and see whether they're going to respond to that parity price. If you see that there's enough evidence to suggest that they will sway to you, you push it as a pulse. Are you with me? Yeah, so that's how you do parity price. Any questions? Don't think about it. It will come with the exam.
Thank you.
But I want you to understand how you do some of these prices so that you can make input. You can make input and decisions, decision making. Alright. So limitations in parity pricing, of course. Your pricing strategy is based on your competitor's strategy. You don't know the pot of money they have. Alright? And you actually, before you realize, you set yourself on fire. Because sometimes you can set the price, you have the swathe of customers coming to you, then you don't have to set it. Yeah, exactly. So you've got to be careful that you just don't do parity pricing, you have to consider other factors. And sometimes by doing that, you may even wash away some of your profits or something like that. Are you prepared?